Welcome to our deep dive for April 16th, 2026. And there's a war escalating in the Middle East right now.
Yeah, it is a very tense situation globally.
It really is. And on top of that, inflation is basically eating away at your grocery budget.
Yeah.
Consumer sentiment is, practically at rock bottom.
Right. People are definitely feeling the pinch.
Exactly. So why did the stock market just throw a massive parade today?
That is the million-dollar question.
Right. It makes no sense on the surface. We're taking a massive stack of sources today. So we've got the daily market briefing, some recent Federal Reserve transcripts, institutional research notes, and just, the raw ticker data.
A lot to get through today.
Yeah, we really want to extract the most critical insights you need to understand what is actually happening under the hood of the U.S. economy right now.
Because it is a wildly contradictory market day.
Wildly contradictory. Our mission today is to decode that, because you have indices hitting record highs while the real-world data points to just serious widespread anxiety.
It really does.
Okay, let's unpack this. Because looking at these major index moves, it feels like the market is operating in an alternate reality.
It's completely split. You have the S&P 500 and the NASDAQ 100 reaching absolute new heights, just aggressively climbing.
Yeah, I saw the NASDAQ chart earlier. It's just a straight line up.
Exactly. But then you look at the Dow Jones Industrial Average, and it is swinging wildly.
Like sharp gains one session and then severe declines the next.
Right. It's highly volatile right now.
I look at that Dow volatility and the S&P's climb,
Yeah.
and it makes me think of driving a high-end sports car at top speed down the highway, but the entire time your check engine light is just flashing bright red.
That is a perfect analogy, honestly.
They're going 120 miles an hour. You feel great, but you know something is fundamentally wrong under the hood.
Right, and in this case, that check engine light is the combination of the ongoing Iran war and, these persistent mounting inflation fears.
So why the divergence? Like, why are the S&P and the Dow acting so differently?
Well, the divergence actually reveals how institutional algorithms and fund managers are mechanically processing that risk.
Okay, mechanically how?
Historically, an escalating geopolitical conflict creates immediate, broad-based panic across everything.
Everybody just sells.
Exactly. But what the data shows today is a market attempting to strictly compartmentalize the risk of a Middle East conflict.
Compartmentalize it.
Yeah. Think about it. The NASDAQ and the S&P 500 are heavily weighted toward massive technology and communication services companies.
Right, the big tech giants.
And the market is calculating that a war in Iran does not fundamentally alter the global demand for, say, enterprise software.
Oh, or like cloud computing.
Or digital advertising, exactly. They are completely insulating the earnings power of those specific sectors.
But the Dow is constructed differently.
Very different.
It's heavily weighted with traditional industrial manufacturing and, transportation companies.
And those are the companies directly exposed to supply chain shocks.
And crude oil spikes.
Exactly. If fuel costs jump 20% in a week because a major shipping lane is threatened,
then an industrial manufacturer just sees their profit margins compress immediately.
In real time. The volatility in the Dow is literally the market mathematically pricing in those margin compressions.
While simultaneously bidding up the tech companies that don't rely on physical shipping lanes.
Right. A software company doesn't care about the price of diesel fuel.
That compartmentalization is fascinating. Yeah. But, it brings up a major disconnect for me.
What's that?
Well, the major indices are technically hitting new highs, but do regular people feel that wealth?
That is the crux of the issue right there.
Because the economic indicators we pulled, they paint a very stark contrast between Main Street and Wall Street.
The macro data is just a massive web of contradictions right now.
Yeah, let's look at the March jobs report. It shows the U.S. economy gained 178,000 jobs.
And the unemployment rate is sitting entirely steady at 4.3%.
Right. By traditional metrics, that is a highly resilient labor market. Like, people have jobs.
They do. It looks great on paper.
But let me push back on that narrative, though. You read the financial press, and the prevailing theory is that consumers are terrified of inflation.
Terrified is the word they keep using, yeah.
But if you look at retail sales data, people are still spending money.
They are.
So if consumer sentiment has genuinely hit a record low, as our sources indicate, why hasn't spending cratered?
It's a great question.
Like, are consumers actually terrified, or are they just complaining to pollsters while continuing to swipe their credit cards at the mall?
Well, they are continuing to swipe, absolutely. But the mechanics of how they are swiping, that has changed dramatically.
What do you mean by the mechanics?
Credit card balances are swelling at historic rates. And savings rates are just dropping off a cliff.
Oh, wow. So it's debt-driven spending.
Exactly. People aren't spending because they feel wealthy. They are spending because the baseline cost of existence has just gone up.
Because everyday goods become more expensive.
Right, due to those supply chain disruptions and the energy costs tied to the Iran war.
So your steady paycheck simply buys less at the grocery store.
Yeah, so you maintain your standard of living by taking on debt.
Man, that is the invisible tax of inflation.
It really is. It erodes your purchasing power from the inside out.
Which perfectly explains why the sentiment data is so deeply negative, even when employment remains stable.
Right. You have a job, but you feel broke.
So the labor market is essentially a lagging indicator here. People have jobs, but their wages just aren't keeping pace with the real-time cost of living.
And the Federal Reserve is staring down this exact dilemma right now.
The Fed is always in a tough spot, but this seems particularly bad.
They are completely trapped between their two primary mandates, right? Maximizing employment and stabilizing prices.
Okay, so with the unemployment rate of 4.3%, they don't really have to worry about the jobs part.
Exactly. That rate gives them the political and economic cover to basically ignore the employment side of the mandate and focus entirely on inflation.
But the situation in the Middle East complicates that wildly.
It does, because officials are now signaling that interest rates will likely stay on hold for quite a while.
Right, they're completely pausing the rate cuts that the market was, desperately expecting earlier this year.
Because if the Fed lowers rates, it makes borrowing cheaper, which stimulates demand.
Right, people buy more houses, cars, everything.
But if you stimulate demand when supply chains are already constrained by a global conflict...
You're just pouring gasoline on the inflation fire.
Exactly. And the New York Fed president issued a very specific warning in these transcripts about this.
What did he say?
He pointed out that the war could simultaneously slow economic growth while aggravating inflation.
Oh, slower growth plus higher prices.
Yes.
That is textbook stagflation.
The worst case scenario for a central bank.
Right, because a company faces higher input costs because of the war, so they raise prices on the consumer, but they also stop hiring, or they begin layoffs because their overall growth is slowing down.
Exactly. The margins get squeezed from both ends.
So, if the broader economy is facing this stagflationary threat and interest rates are staying high, where is capital actually flowing to find safety?
That's the really interesting part. We are seeing massive capital inflows into two distinct sectors right now.
Let me guess. Energy is one of them.
Yes, energy and tech.
Okay, the energy sector's surge makes total sense. It's a direct, mechanical reaction to geopolitical chaos in a major oil-producing region.
Right. Oil prices are hitting record highs because the market is pricing in the risk premium of a massive supply disruption.
So if you own energy equities right now, your portfolio is basically acting as a direct hedge against the conflict.
Exactly. It's the most straightforward trade on the board.
The tech sector trending aggressively upward, that requires a deeper look, I think.
It really does.
Because Microsoft and Alphabet are making significant gains. And NVDA and Tesla, they're basically leading a broader market rally.
They're pulling the whole index up with them.
Right. We used to think of safe havens as, gold or maybe boring utility stocks.
Bonds, defensive plays.
Yeah. But now, in a time of global anxiety, capital is rushing into massive, high-flying growth stocks.
It's totally counterintuitive, but it requires a shift in how we define a safe haven today.
How so?
It's not just about what is familiar or defensive anymore. It is about the financial mechanics of these specific corporations.
Okay, mechanics again. Break that down for me.
We need to look at them as financial fortresses.
Fortresses, yes.
Think about the environment we're in. The Federal Reserve is holding interest rates at elevated levels.
Right, money is expensive.
The cost of borrowing capital is prohibitively expensive for most companies. If you are a mid-cap manufacturing company, high rates are just suffocating.
You can't afford to expand.
Exactly. But if you are Microsoft, Apple, or Alphabet...
You are sitting on tens of billions of dollars in cash reserves.
Precisely. They effectively operate as their own central banks.
Wow, that's a crazy way to think about it, but it's true.
They do not need to borrow money at 7% to fund their operations or their research and development.
They already have the money.
And in fact, they are actually earning 5% risk-free on their massive cash piles just by holding short-term debt.
So their balance sheets completely insulate them from the Fed's rate policy?
Entirely. Investors flock to mega-cap tech not just because, people will still use search engines during a war.
Right.
But because these companies are financially immune to the credit squeeze, that hurts the rest of the economy.
That makes total sense. And plus, with companies like NVDA, you have the added layer of growth expectations.
Huge growth expectation.
Because if inflation is running at, say, 4%, investors need assets that can grow at 8 or 10% just to generate a real return.
Right. You have to outpace the inflation rate.
So tech is being treated as the only engine capable of outrunning the inflation tax.
That's exactly how the market is viewing it.
That makes total sense on a structural level. But tech is not invincible.
Definitely not.
And the sources highlight a massive anomaly in this current rally.
You're talking about Apple.
Yeah. While the rest of megacap tech is soaring, Apple is really struggling today.
Yeah, the earnings reports we are looking at are a bit of a mixed bag.
Microsoft reported incredibly strong numbers, which obviously fueled their stock rise.
But then on the healthcare side, Abbott Laboratories issued weak guidance.
Let's quickly define guidance for anyone who might just look at the raw revenue numbers and get confused.
Good idea.
Because a company can report that they made $1 billion last quarter, which sounds great.
Sounds amazing to a regular person.
Right. But Wall Street trades on the future. Guidance is the company's own official forecast of what they expect to make in the next quarter or year.
And if Abbott lowers that forecast,
Algorithmic trading models instantly recalculate the discounted cash flow of the company, and the stock price drops, regardless of how good the previous 3 months were.
exactly. It's all about what you're going to do for me tomorrow.
Right. And that forward-looking mechanism is exactly what is driving the Apple paradox right now.
It's a textbook example.
Yeah.
Because Apple actually reported strong earnings.
They beat Wall Street's expectations for the quarter.
They did. And yet, the stock is falling.
How does a company report strong earnings, sit right in the middle of a massive tech rally, and still watch its stock slide?
It comes down to valuation concern.
Valuation, okay.
A stock price is essentially a multiple of a company's earnings.
Right.
When investors pile into a stock for safety over a long period, like they've done with Apple, they drive that multiple incredibly high.
The price-to-earnings ratio just balloons.
Yes. The market begins to price the stock for absolute perfection.
And when a stock is priced for perfection, merely beating expectations is just not enough.
Not at all. The market demands blowout, massive growth, just to justify the premium price tag.
So if the growth is just, good, the market basically re-rates the stock lower.
Exactly. Investors look at the underlying fundamentals and decide that buying a share today simply costs too much compared to the actual cash the company is expected to generate down the line.
So the market is saying the asset is great, but the price tag is fundamentally disconnected from reality.
Perfectly said.
And this is not just retail traders getting cold feet either. The briefing notes that Berkshire Hathaway is actively selling off significant portions of its stakes in both Apple and Bank of America.
Yeah, that was a bombshell. Berkshire Hathaway cashing out of foundational American companies during a market rally is a crucial signal.
I want to push on Berkshire's motives here for a second, though.
Sure.
Is it possible this is just standard portfolio rebalancing? Like, if a stock like Apple grows to become half of your entire portfolio, standard risk management dictates you trim the position, regardless of your macro outlook.
Well, portfolio weighting is certainly a factor. You don't want too much concentration risk.
Right.
But you have to look at what Berkshire is doing with the capital after they sell.
Okay, where is the money going?
They aren't rotating it into other equities. They are stockpiling cash.
Just sitting on it.
Yes. Berkshire is famous for a buy and hold philosophy, but they are equally famous for utilizing cash optionality.
Right. Warren Buffett loves his cash reserves.
By holding short-term treasuries, they are getting paid a roughly 5% yield by the U.S. government just to wait.
Wow. So they are looking at the Iran conflict, the sticky inflation data, and the Fed pausing rates.
And they are deciding the risk-to-reward ratio in equities is severely skewed right now.
They want a massive war chest of cash ready to deploy when a market correction eventually creates cheaper valuations.
Exactly. They are taking chips off the table.
That cash optionality Berkshire is exercising leads directly into what we're seeing on the trading floor today, I think.
Absolutely.
Because the money sloshing around the market has to go somewhere, and it is creating some violent swings.
It really is.
Let's look at the specific tickers moving today and unpack the why behind the numbers.
The daily movers really illustrate the macro themes we've been tracking all episode.
Let's start on the winning side. SMMT, Summit Therapeutics, is up 12.95%.
Huge jump.
On semiconductor is up 10.24%. And Albemarle, ticker ALB, is up 9.73%.
So breaking those down, Summit Therapeutics is a biotech firm.
Right.
And massive double-digit swings in biotech are usually tied to clinical trial data or regulatory approvals.
So that's highly specific to them.
Usually, yes. But in a market where capital is frantically searching for yield, speculative money will aggressively chase momentum in these smaller cap names when the mega caps stall.
That makes sense. What about ON Semiconductor and Albemarle?
They are both deeply tied to the electric vehicle and advanced chip supply chains.
Albemarle is a major lithium producer, right?
Exactly. Their surges suggest the market is trying to price in a future where tech-driven manufacturing reaccelerates, despite the current rate environment.
Trying to look past the immediate pain.
Precisely.
But the losing side of the board tells a very different story about that rate environment.
A much darker story.
Yeah. Lucid Motors, ticker LCID, is down 6.88%. Carnival Corporation, CCL, is down 4.18%. And Charles Schwab, SEHW, is down 5% flat.
Well, Lucid is a perfect example of a company being suffocated by the Fed's rate pause.
Because they're an EV manufacturer burning through billions of dollars in capital just to scale production.
Right. And when rates stay high, their cost to borrow money remains incredibly punitive.
And on the consumer side, auto loans remain expensive, which crushes demand for luxury EVs.
Exactly. It's a double whammy for them.
Yeah.
Now, Carnival Corporation is facing a totally different headwind, oil.
Oh, because cruise ships burn a massive amount of fuel.
Massive. They are incredibly energy intensive.
So as the Middle East conflict drives up crude oil futures, Carnival's fuel costs skyrocket.
And that immediately compresses their profit margins, which the stock reflects today.
And then Charles Schwab dropping 5%, that ties directly back to the Fed.
It does. Schwab is highly sensitive to interest rates on our balance sheet.
Right.
If rates stay higher for longer, you see a phenomenon known as cash sorting continue.
Cash sorting?
Yeah, that's where clients move their money out of low-yielding sweep accounts at the brokerage and into higher-yielding money market funds.
Ah, which squeezes Schwab's net interest margin.
Exactly. They lose out on that spread.
Man, the broader narrative is just so visible in the trading volume today.
It's all connected.
Like if you look at the most active stocks today, it is totally dominated by Apple, NVDA, and Tesla.
The heavyweights.
The sheer volume on these specific tickers proves that this tech tug-of-war is dominating institutional strategy right now.
You have capital flowing into NVIDIA and Tesla seeking growth just to outrun inflation.
Right, while capital flows out of Apple due to those valuation ceilings we talked about.
It's a constant rotation.
A listener's portfolio is essentially a battleground right now.
That is a great way to put it.
Because on one side, you have the immediate fear of inflation and supply shocks taking down industrial and consumer discretionary stocks.
Yep.
And on the other side, you have this desperate scramble for the growth and balance sheet safety of mega cap tech.
Let's pull all these threads together to summarize what we've learned from today's stack of sources, because we covered a lot.
We did. The macro picture is clearly being driven by geopolitical instability in the Middle East.
Which is threatening global supply chains and pushing energy prices much higher.
And that acts as a direct catalyst for sticky, persistent inflation.
Which flows right into the consumer data we looked at.
Right. The headline, jobs numbers look strong. But the record low consumer sentiment reveals the true story.
That inflation is acting as a brutal, invisible tax on purchasing power.
Forcing everyday people to basically lean on credit cards just to survive.
And that inflation dynamic has completely boxed in the Federal Reserve.
They are forced to pause interest rate cuts to avoid stimulating inflation further.
Even as they acknowledge the very real risk that the war could trigger a broader economic slowdown.
The stagflation threat. So as a result, capital is hiding in very specific places.
Energy is surging as a direct conflict hedge.
And tech is acting as a financial fortress because their massive cash reserves make those companies immune to high borrowing costs.
But the market isn't blindly buying everything.
No. The valuation concerns hitting Apple, combined with Berkshire Hathaway rotating into cash.
Right. Those are signals that institutional money is extremely cautious about the price tags on these supposed safe havens.
It is a market desperately trying to compartmentalize risk, while the warning signs literally flash all around it.
Which leaves us with one final profound contradiction to think about as we wrap up.
Lay it on me.
The stock market is a forward-looking mechanism. It is pricing in what it expects the world to look like 6 to 12 months from now.
Right, it's always looking ahead.
But every day, consumers live entirely in the present. They feel the price of gas and groceries today.
Every single time they go to the store.
Exactly. So if the S&P 500 is hitting all-time highs while consumer sentiment is at all-time lows, someone's timeline is wrong.
Wow. That is a crazy thought.
Is Wall Street hallucinating a soft landing that simply isn't coming?
Or is Main Street so bogged down by the immediate pain of inflation that they're about to realize the underlying economy is much more resilient than the terrifying headlines suggest?
It's the ultimate tug of war.
Keep questioning the numbers, watch where the smart money moves, and, we will be here to help you decode it next time.